What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is November 18th of 2022. Well, folks, I hope you are having a fantastic day wherever you are, because in today's video, we got to get real and talk about why the domino effect within the crypto industry is about to kick in, and why FTX, while it being the starting point of this contagion, is going to lead towards a lot more destruction, and we're already seeing a lot of evidence of it. We're going to be talking about this and much more as we go throughout the video right after our quick sponsor. And our sponsor for today's episode is our long-term partner, Integral Size. Size is a decentralized exchange that allows DeFi traders on Ethereum and Arbitrum to swap with full MEV protection, zero price impact, and zero impermanent loss for liquidity providers. As we've seen over the past couple of weeks, centralized exchanges are incredibly vulnerable. And as the saying goes, not your keys, not your crypto. But if you want to trade crypto, build up or scale out of positions, or even execute large trades without the risk of utilizing centralized exchanges, you may want to consider trading on Size. Integral Size is 100% self-custodial, trading on-chain, with no centralized entity or third-party custodian able to access your funds and without middlemen messing with your trades, including arbitrageurs. It's pure, simple, fair, and secure. Integral built Size to function like a pro version of Uniswap, so give it a try. Visit integral.link down below in the description to learn more. Alrighty, everyone, so let's go ahead and kick things off here. I want to first just again highlight one big thing that I really think is going under the nose of a lot of people in the crypto space. If we focus on what price alone is telling us right now, it is screaming something it's never showcased throughout history. We are seeing a prolonged period of time where the 200-day moving average, whether it be the standard or exponential, is riding below the weekly moving averages. This not only has never happened throughout Bitcoin's history, even considering the collapse after Mt. Gox, where the 200-day slid right above that 200-week moving average indicated by the orange line. We can see that we have remained below these moving averages for a prolonged period of time, and price is continuing to move lower. This is, of course, coming after the developments from FTX. And whereas many people think it can't get any worse after FTX, seeing how bad things have been, I would say they've got another thing coming to them. We have to be cautious about further contagion, and I'm going to explain why here. We're going to talk about, first off, some of the facts and data that we have, but also utilize some historic examples. The first thing here we need to talk about is Genesis aiming to get a $1 billion loan, an emergency loan, to continue operations as normal. Now, to be fair, this isn't as big of an ask versus, say, what platforms like FTX are in right now, where they were billions of dollars in the hole, at least according to the financials that we have access to now. And if you guys don't know already, the situation with FTX looks incredibly dire. I would say people are going to get little to nothing for what they had on the app. And it's terrible. It's a very terrible situation. But what's more important for us as a broader trader and investor ecosystem is to know that FTX is not alone. There are tons of companies out there who said they have no exposure to FTX, that their books are fine, that everything is going according to plan. And you want to know who else said that before the FTX collapse? FTX, after Celsius, after BlockFi, after all the players like Voyager who claimed that, again, they were in trouble. But again, other players like FTX, they were good, they were okay. And they kept a straight face for months on end until it got to the point where there was too many withdrawals and they needed to freeze them. And we are seeing the same with BlockFi, we're seeing the same with a whole range of players, including Genesis, who paused withdrawals the other day and is now seeking, as of yesterday, an emergency $1 billion loan by Monday. Now, many of you may not know who Genesis is, and that's totally fine. They're not a retail trader-focused company. In fact, they are one of the big underpinnings behind a lot of the major borrowing and lending platforms within the crypto space. They are one of the biggest facilitators of credit to institutional borrowers. Simply put, if you used Celsius, if you used BlockFi, let in a lot of these major players, you're exposed to Genesis. They basically would take your deposits as a retail-facing platform and lend them out to Genesis to get some consistent yield, whereas Genesis would probably charge a premium on top of that to other borrowers. It's as simple as that. So they are a very prime target to get hit by this development within FTX and this contagion of creditors essentially being at risk for not having all of the funds on these platforms that they originally deposited. So this is going to spread a contagion throughout a lot of players if Genesis is in trouble. It's not just about them as a company, but other participants who were exposed to this and are now going to have less potential reserves for their users than they originally promised, right? Now, another thing as well that I think just really puts things into context, if you don't want to take my word for it, take word from John Ray, who is the new CEO stepping in and doing the restructuring process and trying to take over the control of FTX here in the near term, as Sam has basically been ousted from the company. He's talking on Twitter as if he's actually doing something to help the company. FTX has knocked him out. He is no longer a part of the equation, at least in this restructuring, and trying to get a hold on where they stand as a company. John Ray himself, who helped during the bankruptcy process of companies including names like Enron, one of the biggest scandals in publicly traded company history, has stated that this is the worst situation he has seen than ever before, even worse than when he had worked at Enron. He has never seen anything as bad as the books that FTX currently has. Billions of dollars in the hole missing from a company that should be enormously profitable from its core business model of derivatives trading. And if it's this bad for FTX, the second largest exchange in the crypto space by volume and users, what kind of effects is this going to have? We're starting to see it play out for Genesis, coming out and seeking a $1 billion emergency loan by Monday. I don't know who's going to be filling that with the current situation in the market. And if Genesis doesn't get that and Genesis goes under or can't function proper services or facilitate credit, that is going to have a massive effect on the crypto space. I cannot stress it enough. The ability to facilitate loans and keep credit flowing through the crypto system, just like any financial market, is incredibly important. And that is going to cripple volumes and liquidity flow within crypto. Now, I want to go back here to this point about Enron, because there's a lot we can learn about how Enron's bankruptcy proceedings and the worried fallout that a lot of people had, the worry or concern around fallout and contagion was going to be playing within the equity markets. It takes us back to a previous bear market, the likes of which we have not seen in over 20 years, the dot-com bubble. Now, Enron was caught up in this bankruptcy proceeding all the way back in 2002. And as you can see here, we're looking at a Guardian article from January 30th of 2002. And there was a quote that really interested me here. And I think, again, it's just an echo of what's happening here over 20 years ago. This was during the time when Enron was going through its bankruptcy proceedings. And what's interesting is that even though Enron had really been, out of the picture for a while, it was really in 2001, when they started to go through the bankruptcy proceedings, there was this concern of contagion. And the quote, it reads, "The market no longer brushes aside bad news and focuses on the good. As more household names file for Chapter 11 bankruptcy protection and the Enron saga unfolds, questions are being raised on U.S. accounting practices and interests more generally. Forget the military-industrial complex, the accounting corporate finance complex will hurt your pocket." Wow. Very beautifully and eloquently said, and incredibly relevant to where we are as a crypto industry. I mean, really, how did something like FTX go unnoticed by venture capital, by the actual large players who had funds on these platforms? There were so many miniature red flags that just completely went under the radar. And the question is, who else has been exposing these red flags themselves as a company we just haven't yet noticed? Which companies out there are at risk of the contagion of the fallout of FTX, who might have been caught in the same types of business practices and use of user funds for speculative purposes that we just simply don't know about yet? I can tell you guys, if we take a look at when this article was published, when Enron was going through its bankruptcy proceedings, I'm not even going to look at the NASDAQ, but I want to look at more of a mid-market indicator here like the S&P 500. You'll notice that this was about halfway through the bear market here, right? The S&P 500 still had a major capitulation wave from this point here on January 30th. And while I'm not saying history is going to play out exactly the same, my point is that we are halfway through this entire mess in equities and in crypto, right? Crypto may not go down substantially lower down to single-digit $1,000 levels. I'm not saying that that's a guarantee. What I'm saying is that we're at least going to be getting our 80 to 85% bear market correction. What I'm saying is that when we have contagion events like this, it starts to make it where the 200-day moving average, which used to be acting as support during a secular bull market back during the 90s, back during the 2010s, that is now starting to act as resistance. And we can see very, very clearly, if we look at where we stand right now in equity markets, it's doing the exact same thing. Every time we got above that 200-day moving average, we deviated and went down to new lows. Every time we come up, we're having a weaker and weaker reaction to that 200-day moving average. It's starting to act as more resistance. And if we're talking about specifically crypto, not just equities, if we're talking about crypto, to see that we are trading well below the 200-week moving averages and showing no signs of optimism, and people think that we are in a bottom just yet we haven't even had consolidation to the side, we haven't even seen how far the contagion goes. Again, I think people have got another thing coming to them. And if we take a look at the data science models, I think this is a good place where we can wrap things up. We need to try to get an idea visually of what capitulation looks like. Now, this is a really interesting dashboard we have with our partner tool, CryptoQuant. You guys can access it for free down below in the description. I don't see why you wouldn't use it. It gives you a great range of different tools and resources. You don't even have to pay for it. You can sign up for the pay plans if you want some of the additional features. But the big thing here is that within this chart tool, we've got a lot of data science models that give us a lot of information. I've comprised a set of my favorite data science models, and I want to run through two of them real quick. The Korean Premium Index, this is the premium that people in Korean exchanges are paying for Bitcoin versus the broader market range. And as we've seen here, we tend to get these spike ups, these short-term bumps versus the more sustained ones during bull markets when we are seeing people in Korea, the speculators, buying the dip. And while that sounds great, what we find after these spikes is that price usually has more room to go down, and that premium starts to fade. Only when the premium really starts to turn into the red can we start to get interested here. Can we start to find that we might actually have the capitulation we need to sustain a higher move? So there is nothing but speculation here, retail dip buying. What needs to happen in order to sustain prices and sustain against the capitulation and the sell side pressure from all these entities and investors who are scared are investors who feel that this is a substantial bottom and have the serious institutional grade capital to provide that bottom through bid support on the order book, not through market buy orders just yet. We need to get some sideways consolidation. And when I take a look at the Plel multiple, which basically is a ratio that measures how much miners are getting in regards to the dollar value of Bitcoin versus the last 365 days. When I take a look at this, I see that while we are low here, we have yet to do the typical flush to the bottom that we usually see at around 0.2 on the ratio. We have still yet to get this capitulation. We have still yet to see minor capitulation for Bitcoin that usually comes at the end of a bear market. And I think at a minimum, just like we talked about, even if you don't believe we're going to have the worst bear market in Bitcoin's history, even though you might be more optimistic than, say, myself, at least understand that we are likely going to get the 80-85% correction, which takes us down to around $10,000 to $12,000. And we are likely to still test the bottom on these indicators. When I look at the Bitcoin hash rate here and the black range of the chart here, as you can see, right, every single time we had major mid-cycle corrections or the final capitulation wave of the last bear market in 2018, we saw a dip in the hash rate, terahashes, dedicated towards mining Bitcoin. Take a look at the chart now and tell me if you feel we are in capitulation. I don't think we're in capitulation. I think we're still holding up towards practically new all-time highs in hash rate. And while that may seem like a good thing, while some Bitcoin fans would say, this is great, the Bitcoin network is more secure than ever, it means more people are still speculating on mining Bitcoin at these levels. And unfortunately, history tells us that you gotta have capitulation, you gotta have a reduction before things can really get better, before we can have a sustained uptrend. This is not what we want to see. This is the same kind of argument we talk about when we discuss inflation. You still see that there's still so much excess money in the system, still willing to be utilized for speculative purposes. That is not capitulation. That is exuberance. That is greediness. It is people thinking that it's time to pull the trigger, when in reality, the market sentiment and the macro sentiment is absolutely not ready for these types of risk-taking events. The pendulum has not swung yet to the side for risk takers. We need lower prices. We need better market signals. We need more capitulation. It's not something I wish for. It's just history. And we need to listen to history and not focus so much on the noise of the headlines, but what's going on beneath the surface of the industry and what history can teach us. Anyways, I've rambled on a good amount, guys. If you like this video, consider dropping a like. It means a lot. It's a great way to support the channel. And if you guys want to check out Crypto Quant and get access to some of these really great market insights that we showed here, you can check out the link down below in the description. Again, it's totally free. The big thing I want to emphasize is the continued contagion, being patient. It is one of the best habits you can have as an investor and trader. And I promise you all, we're not going to be missing the next bull market here on the channel. We will look out for the right signs and we will ride the wave once they start to signal very clearly to us. But until then, keep active, keep watching the market, keep entertained by what's going on. We keep educated. There's a lot of exciting things going on, for better, for worse, and we're going to come out on top of it, better prepared. That's it for today's video, everyone. Have a wonderful rest of your day, and I'll see you all in the next one. Take care, everyone.